There's finally a change of tone from the BOC last week when they spoke in front of the House of Commons, but it doesn't seem like a lot of people caught on yet. They did the same old talk about the need for interest rate hikes because of higher inflation, but for the first time really, they're also touching on the downside risks of over-tightening. So in this video, let's dive into this, how the bond market is reacting and how these might be affecting mortgage rates and ultimately how it might be changing things up for the Toronto real estate market. But before I continue, if you enjoy content like this, don't forget to give this video a thumbs up and subscribe to our channel so you don't miss other videos like this made specifically for real estate investors in Toronto. We started rate hikes back in March, but it wasn't until July when the Bank of Canada got serious and started front-loading rate hikes. In July, the rate hike went way over expectations, going up by 100 basis points. After that, the BOC hiked rates a bit less each round, going up 75 basis points in September and then 50 basis points in October. They've made it clear that they're not done yet right now, and we're expecting them to go up somewhere between 25 to 50 basis points in December, taking the target overnight rate from 3.75% to somewhere between 4 to 4.25% by December 7th, and that's Wednesday of next week. Now, with these aggressive rate hikes, almost everyone expects a recession coming. And here's the thing, typical recessions last around 10 months long. It's painful, but still relatively bearable. Bucking this trend, however, was the recessionary period between the mid-70s to the 90s that was extremely long. There were actually 4 smaller recessions that happened throughout that period, and a repeat of that is something the BOC definitely wants to avoid this time around. It seems like the BOC has already gotten a good grasp of inflation. Data doesn't show it yet, and it's still expected to be high by the end of this year at 7%, but after that, it's expected to go back down to 3% by the end of 2023 and then 2% by the end of 2024. So if inflation is under control, they'll have to shift their eyes over to our GDP. Right now, the BOC expects GDP to drop to 1% by 2023 and then go back up a bit to 2% in 2024. In other words, our economy is expected to be extremely weak, and they need to treat the situation with kid gloves to avoid slowing things down more than needed, which ultimately has bigger and more harmful consequences. As you can see, this is a clear change in tone from before. After the rate hike next week, we'd be close to 4% to 4.25%, and based on current bank interest rate projections, we might have another small rate hike by the end of January before topping out somewhere between 4.25 to 4.5%. This actually sounds pretty in line with Tiff Macklin's recent statement last week saying that this tightening phase will draw to a close. We're getting closer, but we are not there yet. Again, the bond market is reacting again, and we are seeing an even more inverted yield curve lately. Take a look at this chart that shows the 10-year minus 2-year Canada bond yield spread, and you can see that we've dipped more negative recently. The difference now is close to minus 100 basis points, and this has not been seen in over 30 years. In other words, traders are expecting in an even higher chance of a recession. Interest rates might come down more than previously expected beyond the 2-year mark, and fixed mortgage rates have likely peaked at this point. And so this brings me to the next thing, where fixed mortgage rates are at right now. So fixed mortgage rates are based on 5-year bond yields plus a mortgage spread, which is really up to the bank's risk appetite. What's been happening is that when bond yields spiked, banks have been really quick to follow and hike fixed mortgage rates. On the other hand, when bond yields came down, we haven't seen banks adjust fixed mortgage rates downwards. Perhaps they just want to build a bigger risk premium buffer for themselves. But this week, we might finally see it come down according to some bank sources. We've been using 5.5% interest rates, which seems to be the consensus number these days for number crunching for investment properties. But if this number comes down to 5.2% and more people start using the lower interest rate for their calculations, then this is a clearer sign of a bottom and reversal. In theory, if rents don't change much beyond this point, which I think is pretty likely, then prices can come up by 3% to be at the same break even cash flow position. If you've been watching the market, you might have noticed that there's just not a lot of listings these days. It's true, we have entered the holiday slowdown period by now. But if you are ready to buy, that does not mean that you should just wait until the new year to start looking at the market. It's definitely possible that a deal or two might show up between now and next year, and you'd really only be able to pull the trigger on them if you are ready. And while you wait, make sure you make the most out of your time and get your financing ready, and then you can just reach out to us. You don't have to be actively watching the market over the holidays because that's what our team is here for. We're a real estate sales brokerage that focuses on investing in houses and multifamily homes in Toronto. When you work with us, we take the time to understand your needs, teach you the ropes, show you the deals, crunch all the numbers for you, and eventually help you buy the best one for you. But that's not all. Our team also provides renovations guidance, leasing, and property management if you need it. So just connect with us if you want to learn more about our services by heading to the link in the description below. Don't forget to give this video a thumbs up and look for us on Facebook, Instagram, or LinkedIn if you want to hear from us more regularly. I wish you all the best in your real estate investing journey. Thanks so much for watching, and I'll see you in the next video. Bye!